In this video, I am going to share with you why gold prices are surging and what it tells us about global stability. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics such as stocks, finance, CPF, and basically everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've also covered over 500 videos and over 200,000 watch hours as of August 2024. I also occasionally focus on topics related to regional or world economy. Today, we're diving into a topic that's been making waves in the financial world: the surge in gold prices. Some things never go out of fashion, and gold is one of them. For thousands of years, gold was the global medium of exchange. Until 1971, it was even the standard upon which the US dollar valued itself. In recent years, gold's reputation took a hit from talk of digital currencies potentially taking over its status as a store of wealth, but not anymore. A few weeks back, the cost of a single bar of gold pushed through the US $1 million mark as the precious metals surged to new records. Gold prices have doubled since 2019, and in the past 2 years, they've headed into orbit. Now, you might be wondering, Iggy, why is this happening? Well, let's break it down. First, let's look at the numbers. Gold prices have jumped 21% just this year, consistently breaking new records. This is happening despite most major developed nations signaling victory over inflation, with interest rate cuts in the UK, Europe, Canada, and the first expected this week in the US. This trend has left some experts scratching their heads. Traditionally, gold was seen as a safe haven for investors during times of financial turmoil, but the current surge seems to be driven by a different set of factors. So, who's buying all this gold? It's not just your average investor looking for a safe harbor. The renewed interest is coming from central banks, and they're buying because they're worried about the recent increase in geopolitical tensions. Think about it. We've got the ongoing conflict in Ukraine after Vladimir Putin's invasion 2 years ago. There's the potential for the war in Gaza to spread across the region. And let's not forget the prospect of an escalation in trade hostilities between the US and China. All these factors have brought the era of globalization to an end. But that's not all. There's another big player in this game: the United States. America's huge lift in federal government debt has seen its annual interest bill top its defense spending. The ongoing prospect of endless deficits has undermined its position as the world's reserve currency. This has prompted other nations to look for alternative sources of foreign reserves, and guess what they've turned to? You got it, gold. In the past 2 years, central banks, primarily from Asia, Eastern Europe, and the Middle East, have been desperately scouring global markets to add to their gold reserves. This trend has continued this year, with central banks adding record amounts to their reserves. Let's take China as an example. The People's Bank of China was the world's biggest buyer last year, snapping up 7.23 million ounces. That's the most the country has bought in at least 46 years. This move could be seen as a worrying measure of the breakdown in relations between the world's two biggest economies. China is now actively replacing its US dollar holdings with gold. But China isn't alone. India, Poland, Singapore, the Philippines, Turkey, Iraq, Qatar, Libya, Kazakhstan, and the Czech Republic have all been adding to their reserves. In fact, central bank purchases hit a record in the first few months of this year. Now you might be wondering, what does this mean for the US dollar? Well, there's a common theme running through precious metal markets: concern from central banks about the denigration of what is known as fiat currency, or government-issued money. Back in 1971, America abandoned the gold standard, where the greenback was tied to the value of gold because it inhibited its ability to spend. Since then, debt levels have exploded, raising concerns about America's longer-term ability to continue funding ever-expanding deficits. It's worth noting that while America hasn't bought any gold on the open market since 2006, it hasn't sold any either, and it still holds more gold in reserve than any other nation, which provides a large measure of support for its position as the most heavily backed currency on the planet. Now, let's talk about demand. Until this recent splurge by central banks, gold prices were mostly influenced by the appeal of the yellow metal for jewelry. In fact, this remains the largest source of annual demand. China and India dominate global jewelry markets, accounting for more than half the trade. They're closely followed by Asian and Middle Eastern markets, where there's demand for higher carat gold. As for Australia, our gold producers have been cheering. As the third biggest producer after China and Russia, with 293.8 tons produced last year, Australian miners have been given an extra boost by a puffed up US dollar. At $3,720, it's up almost 25% so far this year. Now let's bring this closer to home and talk about how this might impact Singapore's economy and stocks. As a major financial hub in Asia, Singapore is closely tied to global economic trends. The surge in gold prices could have both positive and negative impacts on our economy. On the positive side, Singapore's position as a gold trading hub could benefit from increased activity in the gold market. The Singapore Exchange, SGX, offers gold futures and options, which could see increased trading volumes. This could boost Singapore's financial services sector, a key pillar of our economy. However, the rising gold prices also signal global economic uncertainty, which could potentially impact Singapore's export-oriented economy. If global trade tensions escalate or economic growth slows, it could affect our trade-dependent industries. As for Singapore stocks, companies in the financial sector, particularly those involved in gold trading or offering gold-related financial products, might see increased interest. On the flip side, if the rising gold prices are indeed a sign of impending economic turbulence, it could lead to volatility in the broader stock market. So, what does all this mean for you, the investor? Well, it's a clear sign that global economic stability is not as solid as we might hope. The surge in gold prices reflects a growing unease about geopolitical tensions and the long-term stability of traditional currencies. For those of you thinking about diversifying your portfolio, gold might be worth considering. But remember, like any investment, it comes with its own risks and rewards. It's always wise to do your own research and consider your personal financial goals before making any investment decisions. If you guys enjoyed this video, then you're going to love my video on how to invest in gold, a beginner's guide. In that video, I break down the different ways you can invest in gold, from physical gold to gold ETFs and mining stocks. I also discuss the pros and cons of each method, helping you make an informed decision about whether gold is the right investment for you. So make sure to check that out next.